Let's jump right in. Welcome to today's Explainer. You know, when we talk about big business, everybody loves to hype up revenue, right? Massive sales numbers, soaring stock prices, all that flashy stuff. But if you really want the unvarnished truth about a company's actual financial health, you have to look at the ultimate scales of financial justice. Yep, we're talking about the balance sheet. Today, we're going to completely demystify this critical document and show you exactly how to read it like an absolute pro.
Okay, let's dive into this. How do you actually measure a company's true wealth? Like, without drowning in a sea of endless accounting jargon, how do we know if a business is standing on rock-solid ground or if it's secretly just sinking in a swamp of hidden obligations? It's a massive question for investors, owners, and even employees. To find the real answer, we have to look past the daily hype and find a reliable way to measure what a company actually has to its name.
Well, to make sense of this, just think about your own everyday life. When you want to know where you stand financially, what do? You log into your bank account, you estimate what your house or car is worth, and you tally up your credit card bills. You take stock of your personal wealth and properties. Companies do exactly the same thing. They use a formal document called a Statement of Financial Position, which we commonly just call a balance sheet, to comprehensively document their exact financial standing. It is literally the corporate equivalent of checking your net worth.
But hold on, there is a vital concept you need to grasp before we look at any numbers. A balance sheet is incredibly time-sensitive. If you check the header of one, you'll see a line that reads something like, as at December 31st, 2017. This is not a video recording of the entire year's operations, because a company's financial position changes every single day. With every sale, every bill paid, every supply bought, the balance sheet acts as a precise frozen snapshot of a single specific day. Usually they prepare these at the end of the year, though you might see them quarterly or semi-annually too.
All right, let's look at the left side. Assets, or what you own.
So, let's break this snapshot down. We're going to divide the balance sheet into two equal halves that must always perfectly align. In the simplest terms possible, assets are what the company owns, items that are going to provide future financial benefits to the business. If it holds value and belongs to the company, it lives right here on the left side, often called the debit side. And to keep things super organized, this left side is broken down by time, creating this really satisfying rhythmic contrast. First, you have current assets. These are the fast-moving, highly liquid items that will provide benefits or just be converted into cash within 1 year. Right below that, you have non-current assets. These are your heavy lifters, the long-term foundational assets that the company expects to use for well over a year.
Let's look a little closer at those fast-moving current assets. In our example here, they consist of three key components. First is cash, obviously the most liquid asset of all, kept on hand for day-to-day operations. Next is inventory. These are the goods the company just has sitting on shelves or in a warehouse, ready to be sold in the near future. And finally, we have accounts receivable. Now that sounds fancy, but it is simply money owed to the company by customers. They receive the goods, they just haven't paid their invoice yet. It's value that's going to turn into cash very soon.
Let's move to and see how this builds when we shift to the long term. Non-current assets. Think of things like heavy equipment or furniture. Let's say our company bought a beautiful new office setup for $200,000. That's a great asset. But as we all know, things lose value as they get used over the years, right? We call this reduction in value depreciation. So to be totally accurate, we have to subtract this depreciation, let's say $40,000 in this case, from the original purchase price. That leaves us with a highly accurate figure known as the asset's current net book value. So we have our current fast-moving assets, and we have the net book value of our long-term, non-current assets. What happens when we put it all together? Well, if we add up the value of all current and non-current assets from our example, it gives us a massive combined total weight on the left side of our scale, exactly $255,000. That is the total quantifiable value of everything this company owns.
Now, having $255,000 in assets is a fantastic start, but it instantly introduces a very compelling mystery. Where exactly did the company get $255,000 to buy all these things? Cash, inventory, expensive office furniture, they don't just magically appear out of thin air. Someone, somewhere, had to foot the bill. To solve this mystery, we have to pivot our focus and look at the other side of our accounting equation.
Which brings us to the right side, liabilities and equity, or basically how you paid for it.
Welcome to the right side of the scale, also known as the credit side. If the left side was what you own, this entire right side answers the simple question of how you paid for it. In the business world, the funds to purchase assets can only ever come from two possible places. You either borrowed the money from outside lenders, or the business owners provided the funds out of their own pockets. That's it.
Let's tackle the borrowed money first, officially categorized as liabilities. This is debt, and just like we did with our assets, we maintain that rhythmic consistency by splitting our liabilities by time. We have current liabilities, which are short-term debts that have to be paid back within a year. Think accounts payable for unpaid inventory or interest on loans. Then we have non-current liabilities. These are long-term debts payable way down the road, like a major $40,000 bank loan.
So the crucial point is, investors and analysts pay incredibly close attention to this specific section of the balance sheet. Look, debt isn't always bad, but if a company takes on too much of it, they are playing with fire. High levels of external obligations skyrocket the risk of bankruptcy. If a company can't cover those liabilities, it is widely considered a very poor investment, regardless of how many flashy assets they listed over on the left side of the page.
The second, and generally much safer source of funds, is owner's equity. This represents the money that belongs strictly to the company's owners. It's their real skin in the game. Equity mostly comes from two places. First is the initial capital, the funds the owners originally invested just to get the business off the ground, say $150,000. The second part is retained earnings. This is the accumulated profit the company has generated over time. Let's call it $60,000. Because the owners take on the ultimate risk of running this business, those profits rightfully belong to them and get added directly back into their equity pool.
And this brilliantly illustrates what a well-funded company actually looks like. When we visualize the sources of funds on the right side of our scale, we see a really healthy proportion. In our example, the company has $45,000 in total liabilities. That's the bank loan, unpaid suppliers, all the debt. But they have a massive $210,000 in owner's equity. This tells us the owners are heavily invested and the business is largely funding itself through its own retained earnings and initial capital, rather than relying way too heavily on outside lenders.
All right, the moment of truth, the perfect balance.
We've explored what the company owns and how they paid for it. Now it is time to bring both sides of our metaphorical scale together. We're going to put the assets on one side, the liabilities and equity on the other, and see if this fundamental accounting equation achieves perfect equilibrium. Let's walk through the final math. On the left, we tallied up all those current and non-current assets, giving us total assets of $255,000. Over on the right, we take the total money borrowed, the $45,000 in liabilities, and we add it to the total money provided by the owners, the $210,000 in equity. So, $45,000 plus $210,000 gives us a total on the right side of exactly $255,000.
Now, what's really interesting about this slide is the profound mathematical elegance it reveals. The total on the right side matches the total on the left side exactly, down to the very last digit. $255,000 equals $255,000. Because these two halves align so flawlessly, the entire financial document perfectly balances. And that, my friends, is exactly why it is universally called a balance sheet. The scales of financial justice are perfectly level.
You now possess the keys to unlock and truly understand a company's most important financial snapshot. But remember, the logic of the balance sheet doesn't just apply to giant corporations. It applies to all of us. I want to leave you with this thought. If you sat down right now, listed out every single one of your personal assets on the left, and honestly tallied up your debts and equity on the right, what would your personal balance sheet look like today? Would you be a sound investment? Thank you so much for joining me on this explainer, and I hope you leave here today ready to balance your own equations.